Hi, this is Dustin with Dustin's Dollars. Today I'm going to be following up on my prior video about Tellurian's line 200, 300 Driftwood pipeline, the new pipeline that was recently approved. And this is in response to a comment that I got sort of asking about, the cash flow this is going to bring in. And I wanted to go in a little bit deeper. It was more than what I want to write in a comment, so I'm making this video hopefully be fairly quick. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Tellurian, so this video should be for entertainment purposes only. Because I could be wrong about everything I say in this video, you need to do your own research before making any investment decisions. All right, so real quick, this is the comment. It was from DEFCON2. He says, thanks, or he or she says, thanks, Dustin, for the video. So did I understand you correctly? This pipeline is really going to cost $1.5 billion to build, to bring in only a small amount of cash flow, $12 million a year. God almighty, that's dumb. So, hi, Transient Stacker. Thanks for hopping on the stream. So, actually, it's even worse than that. If you really want to get down to it, that's $12 million of revenue. The cost to operate the pipeline is, taken away from that. So it would be a money-losing endeavor if we were just looking at it from that perspective, right? And so to recap what was in the prior video super quickly, the Driftwood line 200, 300 pipeline. It's effectively two pipelines, but we're just lumping them together. The whole thing is going to cost $1.5 billion. Has the capacity for 5.4, basically 5.4 BCF per day of transport. I think they talk about it in terms of decatherms per day. I'm going to simplify and just call it BCF per day because to a layperson, to me, I think they're equivalent. But the vast majority of that pipeline, 5 BCF of the 5.4 BCF that the pipeline has a capacity for, is taken up by Driftwood itself, by Driftwood LNG. They're the ones who are actually were the foundation shipper, as they call it here, the ones that actually let them justify and say, yes, we have somebody who is willing to pay the money to use this pipeline. And there was only two different customers, this Sequent Energy Management and Entergy Louisiana, that each themselves are shipping 0.1 BCF per day. So again, Driftwood LNG has contracted for, I think, slightly over 90% of the capacity of this pipeline for a 20-year agreement. And so, of course, like technically, I guess Driftwood LNG is going to be paying Driftwood Pipeline, but they're both subsidiaries of Tellurian as far as I understand. And so that is really not a meaningful distinction to folks who are Tellurian shareholders, because it doesn't make sense to take money out of one pocket and put it in the other. You're not making any money. So the only revenue that you're getting from the current known agreements are from these two customers. And this is for such a small portion of the pipeline that, yes, if that was all they were getting, they would be losing money like crazy, right? And also, just to be clear, again, this is a recap, and I'll move past this as quickly as I can. This is distinct from the Driftwood pipeline itself, right? There's already the Driftwood pipeline that is has enough capacity to feed the Driftwood LNG export facility. So this is the line 200, 300 is in addition to that. So this might leave you to ask, what the heck are they doing here? Why those what's the value, right? Because if you actually read through the approval, they talk through some of the stuff and they say, hey, they set these rates for how much it costs to ship on the pipeline. You can read through the gory details here if you want. He talks about cost per decatherm for their reservation costs and for their actual per decatherm cost. You can multiply it out. I have a spreadsheet in a moment. We'll talk through some of this, but effectively, they set those. They also give some insight into how much they say it's going to cost them to operate this pipeline, right? So at the end of phase 1 of the line 200, 300 project, that's going to cost them about $800 million, not the full $1.5 billion. They say, hey, it's going to have a fixed cost of service per year of about $169 million, and variable costs here, and that really is much smaller. And that is, so that's interesting to know. I don't know if I covered that in my prior video, but the actual approval goes through and says, well, that would, with those numbers and what you're saying you're going to charge and the agreements you have, that would be a 14.5% return on equity. And I think the cash flows would be even higher when you consider that, part of the cost that they're considering is just the depreciation on this pipeline. So, I mean, you'd have cash flows that are higher because depreciation was just an accounting expense, not a real cash expense. But even still, that's, you're not actually getting that return when it is your own subsidiary that's shipping on it. Where does the value come from this, right? Why are they building this pipeline? What's it worth? So I think there's two aspects to this. One aspect, or I guess maybe we should first talk through just slightly, what is different with this pipeline versus just the Driftwood pipeline itself, the original pipeline that is going straight to the export facility location, because this pipeline is also terminating at the export facility location. So what is different is this one, they actually address this in one of the filings on the pipeline FERC docket itself. And so this was actually in response to somebody saying, hey, there's no need for this pipeline. They say, as designed, gas can be delivered to the Driftwood LNG facility, or the shipper has the optionality to deliver gas to any of the other proposed bidirectional meter stations on the project for delivery into the natural gas grid for redelivery to other end users located near or around Lake Charles. And so this is, and they're highlighting this could be for transport or to other domestic destinations. And so here they're making the point that, there's other ways that this pipeline could facilitate usage of gas that is domestic usage as opposed to, liquefying it and exporting it. And so that's one thing to keep in mind, is that this is actually a bidirectional pipeline. They can ship, gas all along this thing. There's a lot of different interconnects. And if you also, read through all the details in this approval order, there was also a market study, which I do not believe was made public, but that Tellurian provided to FERC, where they have some study where they really think there's going to be a lot of demand growth in the region, and that the most pipelines in the area do not have the capacity to meet the expected growth. And so that it would be, I would love to see the actual study to understand what they're saying there, but it seems they've thought about this question, right? They're not just doing this as a shot in the dark. And even more so, if you look through in the footnote here, they're very detailed, and they go through and they say, hey, the line 200-300 project interconnects with 4 pipelines that do not interconnect with the main Driftwood pipeline: the Acadia pipeline, the Louisiana Energy Access pipeline, the Gulf South pipeline, and the Sempra Gillis pipeline. So these are 4 more places where these new line 200-300 pipelines, in addition to just adding capacity to the region between a number of different interconnects, is actually hitting some different pipelines that don't exist. And so that is, strategically important for Driftwood, under where I think they get the majority of the value from this. And this is really, if you look forward, so you have to first assume that Driftwood is going to be built, because if Driftwood isn't built, I don't think this ends up being a very good, a great project for them. That's effectively the whole company is based around Driftwood. But if Driftwood is built, I think having more capacity of gas from more different sources gives them the ability to negotiate lower rates, right? Negotiate lower rates, more places they can pull it from. And that, I think, is really the main strategic importance here. Of course, in addition to, there's the obvious where you might be able to just sublease some of this capacity, right? This interconnects with a bunch of different pipeline systems, and they may actually other people may want to ship more gas from here to there and just don't have the capacity to do so, right? That's the whole part of the fundamental thesis behind, why we're liquefying gas at all, is because it's hard to transport. So when they get this pipeline in there, people might find a use for it. Again, that market study might have more details in there. I don't actually know the details in there. Hey, Stock Mark HQ, welcome to the stream. Stock Mark HQ says you may need the ability to ship LNG back into the system. Yeah, I suppose that might be something that they would do. I mean, the sort of the question here is not necessarily just having that ability, but also the question to ask is why do we need the ability to do it through even more pipelines than what we already have, right? That's really the differentiating factor for the line 200-300 versus just having the Driftwood pipeline. Because I think they could do it there. But yes, that's a great point that this is a bidirectional pipeline. I think that maybe that's what you're getting at, is that I'm not sure that the Driftwood pipeline itself has that ability. So that's actually sorry, in thinking that through, I think you're right. That would be a big differentiator, because I think they called that out somewhere where the original Driftwood pipeline was not designed to be a bidirectional pipeline. So yeah, absolutely. Um, so if we get to some of the actual numbers here, and the way I think about it is, I put together a small spreadsheet. Let me zoom in. It's probably a little small. Maybe 200%. There we go. So for phase one of the line 200 300 pipeline, the total capacity is 3.1 BCF per day. I did the spreadsheet in decatherms per day just because that's how all the literature is for the pipelines. Sorry, real quick. Stockmark HQ says, or an emergency situation. Yeah. So that's actually one more thing, and I know I'm going a bit on a tangent here. I pause on the spreadsheet, but that's another one where I think having some redundancy where they could get the supply, right? Like if they have to shut down one of the pipelines for some reason, they still have a way to get gas there. They're not beholden to only that one thing, because who knows what could happen. I mean, things happen, right? That's all I'm going to say. And if you only had one pipeline that was feeding your facility, and that something happens where you can't ship there, or the person who is supplying you there can't get it there anymore, like maybe it's an upstream pipeline that now becomes the main bottleneck that's preventing you from being able to get gas, they have another option here. Yeah, absolutely. And I think that redundancy, time will tell, but there might come some situation in the future where Driftwood is up and exporting, and they've got contracts where they have to ship gas to folks on a constant basis, and something happens with one of the pipelines, they might be real happy to have the other one. This might just be a cost of doing business, right? That's another another great point. But I think even if this lets them get cheaper gas just because they have more places to source it from, this can turn into a very lucrative deal for them. So if they go through the numbers here, and this is where you get the actual cash flows of, like, I think it comes out to about $11 million per year from these two customers that we do know about, but the majority of it comes from Driftwood himself, which I didn't really count that as cash coming in the door. And so if we add that up, you get the actual direct revenue, about $11 million. But let's say that this lets them save 5% off of the Henry Hub price, because they're able to source gas from more places and get a better deal, right? So if they save 5% off of that, even just for Driftwood LNG phase one, for the feed gas, I sort of multiplied it out here in terms of like who it would be, but really it doesn't matter. I think it doesn't matter, because I think they're going to be able to, the gas costs are going to be borne by all the customers. And so really it comes down to Tellurian's bottom line. 5% savings at $4.20 Henry Hub would end up getting you about $116 million just in savings, right? If they were, instead of able to pay $420, they were paying $380, because they are roughly $380. No, that's not even it. 5% savings at $4, if I can do math in my head. So if they save even 20 cents off the per MMBTU price, that gets them $160 million per year in effectively savings in what they would pay to source the gas. And then you subtract off the actual cost to operate the pipeline. At that point, it gets to be, it's still a little negative at those particular numbers, but it's closer to break even. If this got them to 10% savings, now it's a massively positive bet for Tellurian, right? Because the gas savings go up a lot. They double to about $230 million per year. Now this is actually positive for them. Their savings were so much on the gas sourcing costs that this is good for them in terms of $100 million per year in improved cash flows. And that's on just the phase one of the pipeline. If you use that cost of $800 million for phase one, that would get you about a 13% ROI. But I think there's a couple other things here, where one is that's slightly less obvious, I think, is this might even open up more areas where gas could be produced and could drill, and they can make some agreement with folks who are over in this area, slightly different from where they could source it from, where the places where the Driftwood pipeline can currently reach. And there's another one here, which is this gas savings that I'm talking about. These numbers might seem small, right? Maybe 5%, let's say, seems like a reasonable amount, where having a couple more folks that they can negotiate with might let them get a 5% savings. Hopefully that's not too, I don't know, but hopefully that's not too controversial. Like, I'm not going to say they're saving 50%. They're, save a little bit, 5%. But what I'm getting at is, if Henry Hub prices are only $4, around that cost as they're sort of currently forecast, it's not really a problem for Tellurian in terms of what their feed gas costs are anyways, because they're fairly low, right? Presumably against what we expect the LNG prices to be at JKM or TTF. The real risk that, the commodity risk that Tellurian um, is taking on with their business model is the risk that Henry Hub prices are going to go up, right? That their costs, their feed gas costs are going to be high because of Henry Hub prices, right? And so what's less obvious here is that this optionality gets more and more valuable for Tellurian in the case that is actually, sort of the worst case scenario for them, right? Let's say Henry Hub prices go back up to, like $7. I think they were roughly that a year ago or so. I don't have the exact numbers off the top of my head, but I'm thinking, last year they got pretty high. Let's say they go up to $7 per MMBTU. Now your 5% savings is a lot of money, right? Your 5% savings is now more like what the 10% figure was, or closer to it, when Henry Hub is hovering around $4. And so in that sort of worst case scenario where Henry Hub prices, or the price of US domestic gas in the area gets higher, having more sources to negotiate becomes even more important. Being able to save, some of that money becomes even more important for Tellurian to actually stay, overall positive for Driftwood. So, and this is really where I see the primary, sort of strategic value of the Driftwood, line 200, 300 pipelines. And this is all, again, not to mention the fact that they're going to have excess capacity, and they could make some deals for actually, for using some of the pipeline capacity, and then, contracting out some of the other portions of it to other, sort of like subleasing, I guess. I don't know if there's, limitations against them doing that, or if there's, practical concerns. Again, I'm not in the industry, but that seems like an obvious way to use excess pipeline capacity is to just use the pipeline capacity directly. But I think this gas savings potential is, potentially even more lucrative for Tellurian overall. So that is sort of the way that I think about this. As I've said in the past, it would be great if Tellurian came out and saying some of these things themselves, but because there hasn't really been a lot of transparency around the line 200, 300, or I should say there hasn't been a lot of communication directly from the company explaining what their thinking is for this, but that's sort of the way that I view it. So, all right, that was everything I had for tonight. Holy crap, that was 17 minutes. I apologize. I meant for this to be quick, and I guess I'm a bit long-winded, so sorry for that, but that is all that I had. I know there's a couple folks on the stream. If you had any other questions or comments, I'll stick around just for another minute, but otherwise I'm gonna hop off. Yeah, so that's basically my thoughts on the line 200, 300. Guess real quick while I'm just seeing if anybody else had anything on the who is here on the stream. I did run the same numbers for, the overall Driftwood facility, because both of these pipelines, both the line 200, 300 and the Driftwood pipeline, I think are enough to feed the Driftwood, the full Driftwood facility, all the phases, not just phase one. And again, sort of that's another opportunity for that, percent savings to really multiply over a larger base, right? If they save 5%, even at Henry Hub at 420, over, a lot more feed gas, because they were looking at the full project, that number actually comes out to be even positive for Tellurian, even at those numbers. And, you go up to $7 Henry Hub. Now it's, they're making a good return on that. So, all right, I do not see any more, questions or comments coming from the live stream. So, oh, there is one just right now. Dylan says, how soon do you think they would start? Is that construction on these lines? Sorry, it says start. It says start contractions these lines. I assume constructing. Yeah. So it's a good question. So their stated timeline is it is in here somewhere. Let me find. This might find it. Yeah. So they're trying to build the line. They have it in phases. I went over this in my prior video. I'll go over it real quick here because I know some folks might have already seen that. They have sort of three phases. Phase one is line 200, the full line 200, and then some portions of line 300. Phase two, I think, is most of line 300. And then there's a third phase, which is like, I think, some additional, some of the additional compression or facilities around. I don't recall. But that first phase, they as stated, they plan to start construction soon, like this year. Um, and then they expect it to be in service in 2024, and then they expect the full thing to be, I think, to be in service. Again, this is in the FERC filing, so this is the best timeline that we have. They expect the full thing to be in service in the second quarter of 2026. And like I said, I think there's a phase three, which is late 2026, and that's the point in late 2026 at which they think they'd have the full capacity of the pipeline, you know, available and constructed. But you know, the first portion, the entire line 200, which I think is, don't recall if it says precisely. Yeah, it's a 3.1 BCF. It's in here somewhere, I think, but I believe the line 200 is 3.1 BCF per day, and that's the one that they expect to be in service here in 2024. Now, there's a huge question of exactly how they're going to pay for it. They have said literally nothing. I think there's a lot of speculation that they're going to use their at the money equity offering to, you know, issue a bunch of shares to pay for this. We'll see. I mean, I personally am not super thrilled if that's the case. Although, so they also talk about, you know, the financing. They say somewhere down here where they did talk about the return on equity. It's in that section where they say they're proposing to use 50% equity and 50% debt. You know, so if they're doing phase one of this, they'd have to issue $400 million of debt and then $400 million of equity to pay for phase one here. So that, you know, at their current market cap, their current share price would be pretty painful. You know, hypothetically, if they make progress on the Driftwood export facility, getting that financed, stock price is, you know, much higher than it is today. Let's say it's in, you know, $5 range or even higher. Now all of a sudden it's not, and again, that would put the market cap, you know, $5 with a market cap at, you know, 2.5 billion. Now to raise $400 million, now you're talking, you know, a 20% dilution in the company, you know, which again is still a lot. Don't get me wrong, but maybe you could start to argue that this, you know, starts to be, you know, it's closer to, it's more palatable at least. Like I'm still not, I think there's a lot of strategic value, but if, you know, when again, this is my personal opinion, it's not obvious to me why they're doing this now. Seems like this would be a thing that you would start to do once you have a good line of sight on getting the Driftwood facility built. Because again, to me, unless I'm missing something, and I certainly could be, right? They've done the market study, they have the contacts. Maybe they've got other plans in mind where they know they can start generating cash flow right away with this thing. I don't know. But you know, from what I'm seeing, I think that the strategic biggest value they can have with this is sort of in, you know, getting better prices on their feed gas. So hopefully that answered your question. You know, to give you this succinct answer again, I guess I'm too long-winded, is that I think they have stated they're trying to start construction this year, and you know, to have them have the first portion of this, the line 200, in service by next year, by 2024. So, all right. I don't see anything else on the live chat, so I'm gonna hop off. This has already been 23 minutes. Thank you very much, folks who hopped on, and thank you anybody who's watching.